Please help me welcome Juliana Tu.
Thank you very much. Oh my God, it's so embarrassing actually to sit there and hear that. But, first, 恭喜發財. Everybody have a prosperous and healthy new year.
Like that.
Yes. Okay, now we're going to get started here. I attended a forum put together by the MBA, the ALTA, the NAR, on the TRID, T-R-I-D, the TRID, which is a new acronym. This is the book that they passed out, and it is pretty thick. So I'm here to give you a few words on what is going to be happening this year. So this new acronym, it stands for TILA-RESPA, Integrated Disclosures. It was a whole day event. It was packed with one session after another, with panels comprised of head honchos and legal counsels from various firms, organizations, lenders, and even the CFPB to talk about the changes that will be happening and how we should prepare ourselves. I was one of the panelists, and I represented the viewpoints of the escrow industry through the California Escrow Association and the American Escrow Association. Now, you know the feeling that a day you are really not looking forward to is slowly creeping up, and there's nothing you can do to make it time stand still? Well, this is it. August 1st is that dreaded date. It's the date that the new integrated disclosures will be put on the table. The whole country's lending industry, and consequently, any industry affiliated with the lending industry, should mark this as a red letter day. And here's a little bit of background information for you guys. The Dodd-Frank Act was enacted in July of 2010 after that economic crash that started in 2007, and don't we all remember that? The act called for the promoting of financial stability and improvement in accountability and transparency of the financial system. It also calls for the protection of consumers from abusive financial practices. So a bunch of government agencies were consolidated, and one agency was established to oversee the protection of consumer interests. And this is called the Consumer Financial Protection Bureau, as we call it, the CFPB. You're gonna have to get used to all these acronyms, you know. The CFPB has taken on everything that has to do with the consumer: banks and financial institutions, credit unions, student loans, credit card companies, payday lending companies, mortgages, foreclosures, everything like that. Through their rules and regulations, the CFPB affects a lot of industries, including yours and including mine. While the CFPB put forward the guidelines for the qualified mortgages, you guys know the qualified mortgages, right? Back in January of 2013, they were also mandated to consolidate the good faith estimate, which we call the GFE, the truth in lending disclosure, which we call the TIL or TIL, and the RESPA settlement forms, which we call the HUD-1. So what they're doing is they're consolidating it into what they call the integrated disclosures, the loan estimate, or LE, and the closing disclosures, which is CD. And so therefore, they chose August 1 as the date for all the loans that are submitted after that date, the regulations to take place. And with that, then, of course, we have the GFE, the TIL, the HUD-1 form will be all combined into this integrated disclosure, the LE and the CD. So these are brand new terms that we are going to need to learn. I'm here to tell you why you need to be concerned. There are 5 players in this scenario, and I call them the battle of the 5 armies, CFPB style. The consumer, the lending industry, settlement services industry, which is escrow, cattle industry, and real estate industry. And the importance of what I'm stating today all comes out of the issues of timing and responsibilities. The CFPB rules state that the responsibility for giving the integrated disclosures belong to the lenders. And the rules has mandatory time periods that they must follow in the delivery of the LE or the CD. the penalties are huge if they don't follow the guidelines. For instance, first infraction, $5,000 a day if they don't correct or fail to pay. Continuous disregard, $25,000 a day. Knowingly violating the rules, $1 million a day. Yeah. So you're thinking, why does this affect us realtors? Let's say that you put a transaction together on a purchase of a property and the buyer needs to get a loan. The buyer submits the information to the loan process to start the loan process when the offer is accepted. Now, I don't know if you can read this, but I'm going to spell it out for you. The loan officer is obligated under the new rules to deliver the loan estimate within 3 business days after the application is received. And after the receipt, the buyer needs to send back a, quote, notice of intent to proceed before the next step is taken. Let's say that the loan is approved and the lender is ready to order loan docs. The CD, the closing disclosure, with all the information on the loan, the program they're taking, the cost of the loans, and the cost of the transactions needs to be delivered to the buyer for their review at least 3 business days before signing the loan docs. To prevent any possible mishaps, the lenders are looking to schedule the CD to be sent out 7 business days before the loan signing date. I'd like to show you how it looks if you have a transaction that has to close in 30 days with the timelines that a CFPB is requiring. Now, I know this is very small and you probably can't read it, so I'm going to go over it through with you. On the left side are Sundays. Sundays don't count. That is not a business day. But on the right side, you will see that the Saturdays are considered business days. So we're going to start with day 1 on a Monday. I'm going to come down here and let's see if I can do this. No. Where's the Okay, so on day 1, we accepted and opened escrow. On day 2, the buyer submits the loan. Day 3, the lender mails out the estimate, the loan estimate. And it takes 3 business days. So 1, 2, 3. We're down to day 6 now. Day 7 is a Sunday. Day 8, the buyer gets the loan estimate. Day 9, buyer mails back the intent to proceed. Day 10, the lender receives the intent to proceed. And day 11, the lender starts the processing. And let's give them 2 weeks. I know. In what reality? We go to day 25, 2 weeks. Loan is approved. The lender mails out the CD in 3 business days, right? That's 1 day, 2 day, 3 day. We're down to day 29. The buyer receives the CD and has 3 days to review. 1 day, 2 day, 3 days. Finally, the buyer can sign the docs. This is on a Saturday, day 34. If everything goes well, day 36, the loan docs get returned to the lender. Day 37, the lender funds the loan, and day 38, close of escrow.
What about appraisal?
I know. There are many questions. So what, and I will try to answer that in a minute.
Government to you.
So what is the number of days that we have now in this transaction? We have 38 days, minimum. With everything done immediately, no hiccups, no changes to the loan program. I don't know about appraisal, because the appraisal does not get ordered until after the buyer returns the notice of intent to proceed. Then they start the appraisal. And then, of course, you have to find the appraisal and so forth. But this is given if everything is running boom, boom, boom. Right. But we all know that life doesn't happen this way. So, given the sample, the time periods on your new RPA, the 17 days for appraisal, the 21 days for loan contingencies, the 21 days for physical inspection, and that preferred 30-day closing, it may not work. It really may not work. And here are some other issues. Changes to disclosure. There are 3 changes to the loan program that requires the 3 business day re-disclosure. If you change the loan program and the APR changes, you change the loan product, let's say you go from a 15 to a 30, or you have an addition of a prepayment penalty. So not all the changes require the restart of the 3 business days, but some changes do require, most changes do require the reissuance of a CD. So it will be important that your client knows that every time they change their minds or the figures change on the closing, your transaction would be delayed. What does this mean for escrow? First of all, the lender's goal is to start out with the best information available at the beginning, and they keep the figures the same throughout the transaction, from the issuance of the LE to the issuance of the final CD and the closing date. This means that the escrow officer has to have as close of a figure as they can get right at the beginning of escrow. Now, you know how your clients can sometimes come in and they see the estimate closing statement and then they say, well, I want a discount. Well, after August 1, that will be a problem. The fees have to be set at the very beginning, especially escrow, title, and notary fees, because these are fees that the lender feels that the escrow and title can control. So they are looking at us to have the correct fees right at the beginning. And there is only a 10% change tolerance allowed before the redisclosure has to be done. Now, third bullet point. No changes also means that before the final CD is issued, all the credits that the buyer has negotiated have to be disclosed to the lender. Since a lot of the times the credits are negotiated through the walkthrough should probably be done before the loan documents are drawn. Caesar's laughing.
I remember 90-day escrows. Remember when we started the business.
90-day escrow. Also, the lenders are not allowing a cushion or a pad on the CD. The only changes that they will allow between the signing of the loan documents and the actual closing, those couple of days, will be the change in prorations and recording fees. And even then, we have to issue a new CD after close of escrow to reflect these small changes. Yep. The big lenders will be working with platforms. Now, what are these things? These are software from their loan software that integrates to our software. All the costs that we put into our computer is supposed to migrate directly to their computer. Scary. You know, scary. Everything we put in here, it migrates over there. They don't even have to call or fax or ask us to email. There will be no more HUD-1s. Sorry. These are platforms. There will be no more HUD-1 statements. Don't ask for a HUD-1. You just ask for a closing statement or a closing estimate. Because as you remember, the RESPA is gone. The HUD-1, which is under RESPA, will no longer exist. So we will be issuing the standard estimate closing statement and the final closing statement. One of the unintended consequences of this whole TRID regulation is that the lenders, because they want to control the fees and the costs and prevent any changes, they will also want to control who handles their transactions. That means that there is a possibility that they will approach big title companies and big escrow companies and work out a deal with them for bundled services. What is bundled services? It's when the escrow fee, the title policy fee, the notary fees, the document fees are all one sum, and it's quoted to them. This way, they know what that sum is, and they don't have to worry about any changes in the closings, because it is already set. What this means is that you and your client may no longer be able to choose the services. And it also means that a lot of small escrow companies and in-house broker-owned escrows may not survive. I'm sorry, I should have advanced it over, but here's that. Here's my slide. Taking the choice out of the escrow and title services is something that is really problematic to me. And I don't know about you, but you are the one who's servicing the client, and you should have a say in it. Anyway, vetting. It's the new buzzword. What is vetting? This is a process by which you check out a person's background and to make sure that there is nothing in the background that would give rise to questions or issues about the performance of a certain job. Last time you probably heard about it is when they tried to vet Sarah Palin when she was nominated to be the VP in contention. Vetting. Well, the escrow industry has been fighting against this vetting of escrow companies for almost 2 years. Some lenders are demanding that in order to allow an escrow company to handle their transaction, the escrow company has to submit all of their company information, including policies and procedures manuals, bank accounts, financial information to this lender. They are also demanding that we submit our staff's personal information. We're talking about social security number, driver's license, home addresses, and so forth, to an unregulated third party, so that this company can do a credit check every year to determine whether this person can handle your escrow transaction. And if the escrow company refuses, then the lender tells them that they have to transfer the file to a company who has been vetted or is exempt from vetting. The big title companies are exempt from vetting. It doesn't matter if the transaction is close to closing. It does not matter that the buyer or the seller chose that, the services. The bank simply refuses to allow the transaction to go forward. In January, and that's just last month, HSBC tried to do this in our industry, including many escrow companies who you know in this area, banded together to demand that HSBC stop asking for this vetting. HSBC did back down. But in those 2 weeks of turmoil, some escrow companies lost million-dollar transactions because they refused to submit their staff's private information. And the fight is still continuing with other lenders. And why is this very important? Because HSBC is very big in our community. So I'm here to let you know today that that the real estate sale process is going to be changed. Consumers and the real estate industry professionals like you must be made aware of the changes that are coming. Why do we need your help? With the new timelines, the purchase contracts that involve a new institutional loan will need to have a longer time period. A 30-day transaction is not going to be feasible. The default timelines on the new RPA may also not work. Buyers and sellers need to be educated as to the strict timelines, and consumer expectations need to be managed. If your clients know that it is a different world out there starting August 1, they will be aware, and then our lives will all be easier. Remind your clients they need to decide on the loan program right at the beginning and not change anything. Remind your clients that once the fees given to the lender at the beginning of escrow, changes may have significant effects and delays to the closing. Any changes should be negotiated and decided before the lender sends out the CD. And of course, you remember the CD is sent out 7 business days before the loan documents are signed. That means a walkthrough should not wait until the loan docs are signed and 1 day before close. That's not going to work. Communicate with your escrow officer. Sometimes we have to let everybody remember the escrow officer is in the center of everything. All the information has to come in to the escrow, we disseminate it, and then we disperse it out to the necessary third parties. Are there any credit changes? Are there any credits or changes? Is your client going out of town? All these little things, you must let the escrow officer know. There has to be a two-way flow of information. How many times have I said, how come I didn't know about that credit? Oh, I forgot to send that to you. It's not going to help come August 1. Well, we don't know how everything is going to work out. There are many unresolved and unanswerable questions at this time. We will be working through these issues into the next year. Because a sale contract that is entered into after August 1 is really not going to close until after September 1. So we really don't know how this whole thing is going to work. But we do know this. Communication and collaboration between all the parties, buyer, seller, real estate broker, lender, title and settlement agents will be of utmost importance. Education for all industries must start now, August 1st. Those of you who have come today, you have been made aware. If your escrow officer belongs to the California Escrow Association and goes to our meetings, he or she should know. Those of you who are loan officers at the big lenders have probably already gotten the memo. But what about all those other people who don't come to these meetings? Those who don't keep up with the news or have their heads buried in the sand? What will happen to them August 1? Now, ladies and gentlemen, this is the short version of my presentation. I have a slightly more detailed version that I will be sharing at the Lunch and Learn program on March the 6th. So please come to that if you are interested. Okay, March the 6th, I think right here. Thank you. On behalf of the California Escrow Association and the American Escrow Association, thank you for allowing me this time to speak out. If you have any questions, my contact information is at the very bottom of that slide.